The SEC has just delayed the implementation of the CAT system until 2024. Today I want to talk about what this CAT system actually is, how it was a catalyst, not the key catalyst or the only catalyst, but simply a catalyst of the AMC squeeze, and whether AMC will still squeeze without the CAT system. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, user of Intellect tweeted saying in one sentence, please explain why the SEC delayed deployment of a tool that would give the SEC itself comprehensive market insight, aka market surveillance system, until 2024. Why does the SEC prefer to remain blind? So the SEC has now delayed parts of the market surveillance system or the market surveillance initiative until 2024, but opponents including SEC Commissioner Hester Price want the agency to scrap the whole project altogether. Now the slightly worrying thing is this CAT system wasn't newly created in 2020 and 2021 with the implementation date set for 2022. Instead, this CAT system was actually proposed all the way back in 2012 and was supposed to be implemented nearly 10 years ago. Now you may say, Tom, what is the CAT system and how does it actually impact the AMC squeeze? So the Consolidated Audit Trail or CAT system is a regulatory reporting utility commissioned by the SEC to enable regulators to more fully track trading activity, such as long and short positions, and boost transparency. So at its core, the CAT is a central repository that will receive, consolidate, and retain the trade and order lifecycle data for all NMS securities, i.e. listed securities, and over-the-counter equity securities as well. So importantly, exchanges, self-regulatory organizations, and broker-dealers are required to submit lifecycle information to the central repository for each trading day on a nightly basis, aka no more T+2, but instead T+0. And in future phases of the CAT, broker-dealers are required to submit significant customer account information, i.e. name, address, large trader ID, year of birth, and more. This way the CAT system could more accurately check or more accurately track who exactly is shorting which stock and how many shares they're actually shorting. So effectively that forces all of these hedge funds, market makers, broker dealers and everybody else in that space to report more information on trades like short sales and like synthetic shorting. Therefore this CAT system effectively would have made synthetic shorting very, very difficult, if not impossible. Now obviously that's a very high level summary of the CAT system. If you want to learn more, be sure to check out Jan-Jack, Rizzo, Hang Loose, Bigums and many other guys over on Twitter because they've gone much further in depth than I briefly explained. But so effectively this CAT system would definitely have helped the squeeze and it was definitely a singular catalyst for the squeeze, but obviously importantly not the only catalyst, and I do believe the squeeze will still happen regardless. As Will Andrews tweeted, he said the good news is that all past squeezes have happened without the CAT system as well. Now obviously it's very, very easy just to Google a quick list of famous short squeezes that have already happened. You've got Volkswagen, Tesla, AMC and GameStop, which I'll touch on in a second. You've got Harlem Railroad, Carla Bios, Herbalife Nutrition, Piggly Wiggly, Northern Pacific Railway and many, many others not listed here. Now yes, when AMC and GameStop ran up back in January and June of last year, it wasn't a full short squeeze because obviously the shorts never covered. However, the thing that curtailed the AMC and GameStop short squeeze and the only thing that prevented these stocks from squeezing was the removal of the buy button. Now, would the implementation of this CAT system have caused the buy button removal to have never happened? No, the CAT system is just around reporting trades and trading activity and nothing to do with removing any such buy buttons. And therefore, all of these past squeezes and the previous mother of all short squeezes, like Volkswagen, have happened without the CAT system. But something I do think is very interesting that slightly slid under the radar when this CAT system was prevented or when this CAT system was delayed was this tweet from Joey Cameron. He said the SEC has just approved single stock leveraged ETFs. He said, what? How does this benefit the everyday investor? This needs to be repealed as soon as possible. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to $25,000 in total and a guaranteed free share of Lucid on top of that. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, they clear their trades themselves through their clearing broker, Futu Incorporated, which does also not sell your order flow. Therefore, Moomoo is brilliant for buying those AMC shares. I think it's one of those classic release a big news story to cover up another big news story, and that's exactly what's happened with this tweet here. He said many already over-leveraged hedge funds are just going to double down on their already bad plays. How tone deaf can you be? So far there's no announcement of any leveraged AMC or GameStop ETF, but there is going to be a leveraged inverse Tesla ETF. Infinite Liquidity Machine tweeted saying single stock inverse ETFs. I guess the shares in swaps had to go somewhere. Well, there you go. He said why it matters for you. They can effectively short these inverse funds or these inverse ETFs, essentially creating a long position on stocks like GameStop, AMC, Tesla, and many others. He said it's effectively an insurance policy on the squeeze. This way, if they short these inverse ETFs for AMC and GameStop, they effectively have a synthetically long position on AMC and GameStop. And then when AMC and GameStop do squeeze, these shorts actually make money because they'll be making more money on the squeeze than they'll be losing on their synthetic shares. Because it's a leveraged ETF or a leveraged inverse ETF, they can effectively buy one share of this inverse ETF, which would be the equivalent to shorting 2 shares, or maybe even shorting 3 or 4 or 5 shares. Therefore, they can effectively hedge their synthetically short position with this leveraged inverse ETF. But actually, this could potentially be a very good thing indeed. Back in 2008, these major banks didn't mark Michael Burry's credit default swaps accurately until they'd secured a net long position themselves. When these major banks still had tons of mortgage-backed securities, tons of CDOs, CDO squared and synthetic CDOs, they wouldn't mark the credit default swaps accurately because they'd be recognizing billions of dollars in losses. It wasn't until these major banks acquired tons of these CDSs or credit default swaps that they could finally mark them accurately when they were net profitable on a trade. When they held more in credit default swap profits than they had losses on CDOs, then they could mark the CDSs accurately and generate all this profit. This could effectively be what these hedge funds and major banks and major institutions are doing right now with GameStop and AMC. They're going to build up massive inverse positions on AMC and GameStop, or massive inverse short positions on AMC and GameStop, and then finally allow the stock to squeeze, or the stocks to squeeze, when they stand to make more money than they actually lose. But something I do know is the market crash is still absolutely going to happen, is still absolutely happening, and these hedge funds are still very, very likely indeed to end up being liquidated unless they can secure a net long position on AMC before the liquidations happen. Act10 tweeted saying the consistent theme of 2022 is that pundits, economists, and investors have been way too bullish every step of the way. Now featuring the first 1% interest rate hike in 42 years in a likely recession. You can see that every time the Fed has hiked interest rates over the last few months, the S&P 500 continues to gap down or continues to stair-step downwards, and I do expect the same thing to happen when this 1% hike actually takes place. As I said, this 1% hike is now effectively guaranteed with 100% likelihood, and they may even hike by 125 basis points. As such, Bank of America is now forecasting a mild US recession in this half of 2022. They've said we've therefore lowered our year-end target from 4,500 points to 3,600 points for the S&P 500, a 25% decline. Therefore, instead of the S&P 500 bouncing up and making a full recovery, Bank of America are now expecting the S&P 500 to continue falling, and that's in their best case scenario. Goldman Sachs, on the other hand, has said if there's no recession, they see 4,300, but if there is a recession, like Bank of America is saying, Goldman expect 3,150 for the S&P 500, a further 17% decline. Currently, the S&P 500 is still sitting at 3,800 points, and therefore Goldman is still expecting the S&P 500 to fall by around 700 or 650 points. And don't forget, these major banks, as Mac10 says, are still being way too bullish. Therefore, the S&P 500 is likely to see under 3,000 points, which is, I think, this final Hail Mary crash. If over the next few weeks or the next month or two, the S&P 500 crashes from this 3,800 mark all the way down below 3,000 points and down further, that is certainly the Hail Mary crash that will cause tons of hedge fund liquidations and the shorts to be forcibly covered. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.